Welcome back to AlphaIndex. We live in a world obsessed with doing. We are told to work harder, hustle faster, and stay on the grind. But what if the most profound financial truth isn't about doing, but about thinking? What if the real game is about understanding principles, not just chasing trends? Today, we're not talking about a hot stock or a get-rich-quick scheme. We're talking about a foundational truth of modern wealth building. We're going to peel back the layers on three of the most misunderstood and powerful tools in the investor's toolbox: mutual funds, index funds, and ETFs. Now, most people explain these with complicated metaphors about baskets of apples and different fruit stands. We're not going to do that. We're going to talk about something deeper. We're going to talk about philosophy. We're going to talk about control, the principle of delegation. Let's start with mutual funds. Imagine you're a king. You have a lot of gold, and you want to build a kingdom. You can't personally oversee every single project. So, you hire a brilliant, well-regarded architect, a master builder. You hand them your gold and say, "Build me a magnificent castle, a grand library, a thriving marketplace. Use your expertise. I trust you." That is a mutual fund. It's an investment vehicle run by a professional fund manager. This person, or team, is the master builder. You hand them your money, and they actively decide which stocks, bonds, or other assets to buy and sell. They are constantly analyzing the market, trying to outperform it, to build you a better portfolio than you could build yourself. The upside? You are delegating your financial future to an expert. They have access to data, research, and insights you don't. The hope is they are a genius who can navigate the storms and find the hidden treasures. The downside? That expertise comes at a cost. They charge a fee, often called an expense ratio, for their service. This fee is non-negotiable and eats into your returns, whether they win or lose. And here's a humbling truth. Most active managers, most of the time, fail to beat the market after their fees are factored in. The genius is not as common as we might hope. Mutual funds are the embodiment of delegating your decision-making. You're saying, "I don't have the time or the skill, so I'll pay someone else to do it for me." The principle of humility now. Let's talk about the index fund. This is a profound shift in mindset. Instead of hiring a single master builder, you look around and see all the great castles, all the successful kingdoms already built. You come to a realization. Trying to pick the single best one is a fool's errand. So, what do? You decide to own a little piece of every castle. An index fund is a collection of stocks or bonds that tracks a specific market index. The most famous example is the S&P 500, which holds a piece of the 500 largest publicly traded companies in the US. There is no active manager. There is no genius picking winners and losers. The philosophy is simple. The market as a whole is smarter than any single individual. This is a principle of humility. You are admitting you cannot beat the market, so you will simply become the market. You accept the average, knowing that over the long term, the average tends to be phenomenal. Because there's no highly paid manager, the fees on index funds are incredibly low. This is a crucial point. Lower fees mean more of your money stays invested, compounding over time. This small difference is the silent engine of long-term wealth. The core idea here is that you don't need to be brilliant. You just need to be patient. You let the natural growth of the economy, the relentless innovation of humanity, do the work for you. The principle of immediate control. Finally, let's discuss ETFs, or exchange-traded funds. An ETF is like an index fund's younger, more agile sibling. It also tracks an index, so it follows the same principle of humility, but it introduces a new principle: immediate control. A traditional mutual fund is traded only once a day, after the market closes. You place an order, and it executes at that day's closing price. It's a bit like buying a train ticket for a trip tomorrow. An ETF, however, trades on a stock exchange throughout the day, just like a single stock. You can buy it at 10 a.m., sell it at 2 p.m., and buy it back at 3 p.m. You have minute-by-minute control over your investment. This makes ETFs incredibly flexible. They are often used for strategies that require rapid entry or exit from a position. You can track everything from the S&P 500 to the price of gold, to specific sectors like clean energy or artificial intelligence. So, while the index fund and the ETF often track the same thing, the difference is in the how. The index fund is a long-term savings vehicle. The ETF is a long-term savings vehicle with the added ability to be a day trading instrument if you so choose. Conclusion. So, what is the ultimate truth here? The decision to invest is a choice of philosophy. Do you believe in delegation? Do you trust a master to do the work for you? Then a mutual fund might be your path. Do you embrace humility? Do you believe that the collective wisdom of the market is the ultimate force? Then an index fund is your answer. Or do you value immediate control and flexibility, the ability to act on a moment's notice while still holding a diversified portfolio? Then an ETF is your tool. In the end, this isn't about choosing one over the other in a vacuum. It's about understanding the core principle behind each. It's about asking yourself, what kind of investor do I want to be? What kind of relationship do I want to have with my money? The greatest wealth is not found in a hot stock tip, but in a clear mind and a well-defined philosophy. Once you understand the principles, the tools become obvious. If this video has sparked a new way of thinking for you, if it's helped you see the world of investing not as a game of chance, but as a game of principles, then please hit that like button. Share this with someone who needs to hear this. And if you haven't already, subscribe to AlphaIndex for more hidden wisdom on finance and investing. We'll see you next time.